2015 is an interesting year because that's when The Big Short was released, the movie, right? Everyone wants to be the next Michael Burry.
The US equity market now is becoming completely split, and not like a 50-50 split. Basically, US equity markets are held up by 7 companies.
Why?
People get nervous about this, right? Because they'll
Yeah,
go,
but
oh,
why?
diversity.
Why?
I need to diversify
Do
my
you like
portfolio.
money? Do you like money, or do you like talking about your portfolio? Like personally, I like money.
Yeah.
I like being able to go and spend stuff.
Yeah.
I don't care about the intricacies of, oh no, you got to be diversified. That's for losers.
Hello and welcome to The Market Edge. Now, should we be selling everything? Well, before we get into that, let me quickly do the disclaimer. This podcast is for educational purposes only and is not intended to be financial product advice or any investment recommendation. Stay tuned for additional disclaimers at the end of the episode. Should we be selling everything is what we're talking about today. Retail traders, they love 2 things. Number one, they love buying everything, number one. But number 2, they love selling things when they shouldn't be. Placing wrong trades mainly is what they also like doing. But we're talking about here boom markets forever. Markets are turning around. Well, are the markets turning around a bit? There are signs, and I suppose what we're looking at is what are those signs that this is turning a little bit.
I think
should everyone be selling everything? Basically?
Yeah, I think one of the biggest things is when people see a parabola going.
Yeah.
When the market's going absolutely insane.
Smashes a word out of nowhere in the first 30 seconds that I don't understand.
So when it basically goes straight up. So
what does that word mean?
See gold, for instance.
Yeah.
Right. Gold hit another all-time high just over last night in the futures market.
Yeah.
When you see, a lot of the kind of lesser quality stocks. So 39% of retail are now involved in companies on the NASDAQ that don't make any money, or at least they're making up a proportion.
39% of companies on the NASDAQ don't make any money.
No, the companies that a lot of retail are buying now make up about 39% of that retail flow. And those companies are non-profitable or non-revenue making companies really on the NASDAQ, which is insane.
Yeah.
They don't really make any money. But it shows you kind of why people might be leaning towards this sell everything thing. And when they start seeing cracks, like the other Friday when China and the US had a little bit of another trade war emerging, which has dissipated already.
Well, let's go back to that, I reckon. Let's just kind of paint this picture of why we've started this. The day Trump come out with his rant about trade with China, 100% tariffs, blah, blah, blah. There was absolute panic in the market, right? It was one of them bloodbath days. We see them all the time, but one of them days. Then the old taco trade, Trump always chickens out, right? Came into play.
But also caco.
What's caco?
China always chickens out too.
Right, yeah, fair. So they paid off against each other. Taco trade, which means actually nothing happened. Yeah. And then markets recovered and they're now not fully back to where they were, but they're on their way back. Yeah. But that was the start of this whole discussion point, right? But I suppose the signs go way before this, right?
Well, I said a couple of weeks ago, actually a day or two before all that nonsense kicked off, that the China-US trade war was a non-story now. And it's purely because of what happened, the taco and also caco in this current context occurred. And so when you know what the limit is, so like Trump was like, oh yeah, there's 100% tariffs. Any slight improvement on that is going to buoy markets again. Yeah.
And we know that, we kind of know the story though, don't we, with these now? Because Trump comes out with outlandish statement. China comes out with retaliatory statement. Yeah. Trump draws back a little bit. Mm-hmm. Markets go up. I mean, it's the tactic to boost markets. Because fundamentally what Donald Trump wants is stock markets to be higher. Stock markets higher equals headline that he can go shouting about.
People happy, but apart from liberals. But if we look at the VIX, that is possibly where we're looking at this kind of dissipation now in fear. I don't like to use the VIX as a fear gauge. I think it's nonsense.
Known as the fear index, right?
Yeah, but CNBC and these other outlets, they like to use the VIX as a fear gauge. It's not. It's just a relative change in volatility implied by 30-day variance swaps on the chain of S&P 500 options.
Yeah, go on.
But anyway. It gets a little bit more complex than the fear gauge is what I'm talking about. Yeah. And so when we're looking at the VIX in the current context, there is a slight kind of differential we can look at, and we're going to look at a chart that comes later. But we can see that,
I think the chart's here now.
No, and a different chart related to this. But we're going to look at how we've dissipated since then. And, people have started selling volatility again.
Yeah.
Now, something that I really like in this context is then if we look at Tesla. And we can get the Tesla chart up here. And you can see that although Tesla is a massive component of that Mag 8 now, with Broadcom included, it's not actually done that much since all of this nonsense kicked off. And this is one of our picks from the start of the year.
It's actually set up quite a nice little head and shoulders formation.
Which way? What, to the downside?
No, that little bit at the top, if you were to zoom in, this is like a...
Oh, I see. Okay.
That little top bit.
Yeah. But you can see that higher beta companies, so companies that move more than the S&P, either up or down, they've not actually been that affected, which shows how limited compared to when we had the Liberation Day nonsense back in April, compared to how they reacted then.
Yeah.
We can say that the tariff trade is dumb now. There are cracks, though, I think, and it comes in a second. But with Tesla and similar stocks, I think there's still a lot of upside left. So it's about asking the right question. Sell everything. In which asset class, in which kind of tranche of equities are we talking about here?
Everybody wants a crash. Crashes come out of, everyone's calling for this, or everyone's calling doomsday there or there, because, we're always looking at talking heads here and they're saying that and someone else is saying that. And so everybody's always looking for that big downside, and even though can we not just always say there are signs? If you look hard enough, there's always signs that things are going to all sell off.
The interesting thing I think is 2015 has absolutely warped people's minds.
Yeah.
And 2015 is an interesting year because that's when The Big Short was released, the movie,
the film,
right? Everyone wants to be the next Michael Burry.
Yeah.
And yet they don't understand the context of the difference between 2007 and 8 and now in terms of liquidity, in terms of how much the passive index is contributing to the market consistently having a bid and being pushed higher. Talking about the extent to which Americans have become so wealthy that even the lower income families have relatively decent equity exposure compared to the rest of the world. These guys are putting $200-300 a month away. Whereas here, I don't think that even happens amongst lower incomes.
No.
Right?
100%.
And so the bid in US equity markets is insane. So consistently trying to bet against downside. I mean, all the short sellers have been decimated over the last couple of years. Decimated. The really famous guys.
Yeah.
Citron, who wrote the famous short selling newsletter, they closed their short selling book down. Hindenburg, another famous short seller, he stopped producing research because he was like, I'm done, I've made enough money and it's becoming too hard.
And all my research is wrong.
Yeah, everything's becoming a long now. And it's like even the fraudulent companies, Carvana. I'm long Carvana, actually.
Yeah.
I know it's full of absolute crap, which is quite ironic, really.
I was concerned about what C word you were going to use then.
Yeah, well, yeah, you should be as well. But, I think you have to go with the market, and consistently thinking about selling is insane. However, and we'll get onto this next chart here, which I've dug up. This is showing the difference between the Treasury yield across different tenors and different tenors of CCC rated debt. So dog crap debt.
So let's go back. I suppose let's go back to the whole Big Short. Actually, Big Short is a good reference within this, right? So remember within the Big Short when we were talking about the tranches of subprime mortgages, they're all AAA rated, BBB rated, CCC rated, and then you get ones that had mixtures of all the other dead crap at the bottom, right? Now, when we're talking about this, we're talking about dog shit, right? Proper. So that's what we're looking at here, right? Absolute crap.
Yeah. And so an interesting thing in the current context, a company called First Brands over in the US.
Yeah.
They've basically had a really dodgy balance sheet.
Yeah.
And it's been found out. However, I think this is going a little bit broader now across other relatively poor fundamental companies in the US. Companies that we're aware of their debt is relatively poorly rated, but at the same time, what we're seeing is Treasury yields coming down. So effectively now, that debt is being made to look worse because these companies' debt yields are remaining higher whilst Treasury yields are coming down. Therefore, that differential is now getting bigger and bigger. And this is what we can see in this chart. And conversely to the VIX, you might notice that this yield, and they're not the same measure at all, don't get me wrong.
No.
However, this yield has not come down in the same way that equity market volatility has.
Yeah.
It's remaining higher because we're now seeing Treasury yields come down a lot more. Bond prices going up. And so I think that might be one issue coming for poorer fundamental companies, and one risk to the retail investor, whereby we're now seeing loads piling into speculative stocks. However, that yield spread increasing. People are probably going to start looking for safety in those higher market cap tech stocks, in my opinion.
So the safety, but this is the point I have here is when we look at the sell everything idea, the US equity market now is becoming completely split, and not like a 50-50 split, like a 7 and the rest split.
It's brilliant, love it.
So basically US equity markets are held up by 7 companies.
Yeah, about 40% of the concentration of 40% of the price move is conducted by 8 companies in the US. I love that. It makes my job so easy because I know what to be overweight in.
Yeah.
And then when I want to get a bit tactical, I can go and buy.
But people get nervous about this, right? Because they'll go, diversity. I need to diversify my portfolio.
Money? Do you like money, or do you like talking about your portfolio? Like personally, I like money. I like being able to go and spend stuff.
Yeah.
I don't care about the intricacies of, oh no, you got to be diversified. That's for losers, quite frankly. You're looking to extract as much money from the market as possible over a certain period of time. Various different ways in which you can do that.
Hence why you buy things that are going up.
Exactly. And so if you're looking at the top 8, and Nvidia has done, what, a couple of 1,000% perhaps in the last couple of years?
Yeah.
You've got Tesla since 2013, done insane. You know, these companies are there and at the top because they're actually doing stuff that is innovative.
This is why I always get this, and retail traders kind of overcomplicate themselves and get in their own way, don't they? Because they go, well, I'm not going to trade on all these Mag 7 stocks because everyone's trading on them. There's a reason everyone's trading them, number one, and just buying them going up. But that's when they go into the S&P 500 and look at these crappy stocks around there and look for value in these areas and look for a bit of value there, when actually you don't really need to.
No.
You know, because a lot of those companies are, as we're saying, not in good positions.
The difference is that, you know, if you're a fund or if you're a hedge fund, you're looking for alpha.
Yeah.
Because you have a mandate across certain volatility parameters. There's a certain way in which you're trying to meet certain returns. And so you might go looking for value. You might have to run a crap load of fundamental analysis on a balance sheet, find certain bits of data to try and find where, you know, the market's undervalued. And so you might go and pick a stock that no one's heard of, for instance.
Yeah, which is a bit riskier.
Right. But for the average investor, when you're using 100K or whatever, and you're trading with that, it's not, your edge doesn't get eroded by just being long risk premium.
No.
So you're long certain factors of the market that you know will make money, but that's not the same as edge or looking for inefficiencies.
But, and even to this point now, you would go, oh, well, if you go for those riskier, you know, if you're going into the risk trade and looking for something with value, if you get it right, you'll make your money quicker. But that's not even true anymore, because these stocks are just ridiculously strong all the time and moving higher at quite rapid paces.
Well, yeah, because if you say you're long something, it goes up 40% in a day, or something like that. That's 320 vol. To be able to limit your risk, you're going to have to run a strategy that's over 4 sharp.
Yeah.
Right? No one is running a strategy at 4 sharp who's a retail investor.
Yeah.
Even institutional, even any hedge funds, they do not run 4 sharp strategies.
Yeah.
And so I think a lot of the issue as well is when people see stuff going up so quickly, they think that they become a genius.
Yeah.
When actually the genius is being patient over a much, much longer period, and obviously being tactical at certain periods too.
Yeah.
But you know, it is what it is, and I think.
Now you could say we're contradicting ourselves a little bit here, because we've said in the past that risk a lot of the time is something that people are very reluctant, especially in the UK, very reluctant to get into, you know, and trading is inherently risky, right? It is a risk every time, even if you're buying Nvidia shares, it's still risky, it still can fall off, right? So are we being a bit contradictory here?
No, because I think risk is a difficult topic, because you have to actually understand risk and what it is sufficiently. Let's say
when we talk risk here, we're not just talking stop losses, right? So.
No. When you catch a stock and it goes up, say 40% in a day or a week, what you should inherently say is, I was very, very lucky there. It's not down to my genius.
Yeah.
The second you try and replicate that over time, you will likely face a left tail event whereby everything sort of just blows up in one day.
Yeah.
Right?
Yeah.
So it's kind of one of these things where you should really attribute some of these big wins over short periods to your luck. Yeah. You should never attribute it to your genius. And I think that's an important concept in risk. Yeah. Because a lot of these times it's not repeatable over short periods, that is. Over long periods, completely different, because you're looking at an actual fundamental basis. But over short periods, it's likely capital flows and someone else knows more information than you, so that market moves quicker.
Which in retail trading is always the case.
Oh yeah,
everybody knows everything more than you, and that's not a slur. That's not having a go at people. Mate, of course they do. Everybody knows more.
Insider trading happens all the time. It's just they don't get caught.
Yeah,
it's all the time. The ones that get caught, probably like 5% of the total amount of insider trading that occurs. Yeah, and so when you see these biotech stocks pop off and go insane, or I don't know, miner or something like this, there is always information beforehand. Yeah, I mean, look at the Oracle one. Do you remember Oracle?
Yeah.
Mate, someone made like, what, 5-6 million off of that after buying some calls the day before. Of course, that was inside information. But I think, when we're talking about sell everything, it's important not to crap your pants, but it's also important to pay attention to certain factors.
So we've got to the point, really, of sell everything apart from the Mag 7 stocks.
I would suggest that the market becomes more overweight the Mag 7 over the next quarter, because
they're the only companies making any money.
Well, they're deemed as safety. It's funny. It used to be Treasuries that was safety. It's now Mag 7 that's safety.
Look at banks, right? So when we were recording this week, look at the bank earnings this week were ridiculous, or last week were ridiculous.
Mate, JP Morgan is one of the strongest stocks in the world to hold.
It's like gratuitous amounts of...
It's disgusting.
It's filth.
It's disgusting.
Yeah.
I love it.
Okay, so there's one more bit that we want to touch on here.
Yeah.
Go for it.
The US economy.
Yeah.
The fundamental basis as to why the stock market goes up is because corporates return more profits. And if corporates are returning more profits to shareholders, what does that mean? The US economy is growing.
Yeah, GDP goes up.
And so you want to be long the companies that are returning money to shareholders. That is literally what the stock market is for.
Yeah.
And we just revised US growth from 3.3% to 3.8%.
Yeah. And actually, this week, Chinese GDP came out, and you can gauge Chinese GDP however you want. It's not always that reliable.
I take it with a pinch of salt.
Yeah, but this one was bad.
I know.
So in which case, it's a lot worse than that.
Mate, the Chinese consumers have been battered.
Yeah.
They still are. They've been battered for the last 4 years. And so whenever there's this conversation around, and I've mentioned it about 10 times on this pod.
Yeah.
You look at Chinese GDP per capita, it's about $13,000. US GDP per capita is $90,000.
Yeah, it's a lot.
$90,000.
Yeah. That's not only a lot, it's a lot more
and yet,
China.
And yet people want to start talking about, the US versus China war. Who'd win? Mate,
there is no war.
There is no war. There is no war. It's literally just complete posturing on the part of Chinese. And Trump knows this. That's why he can say all these stupid things like 100% tariffs, then walk it back.
Yeah. Because they know exactly what's going to happen.
There is no competition.
Yeah.
Do you remember DeepSeek?
Yeah.
Everyone now is talking about AI in China and all this.
What a joke that was, by the way. Oh my God. You look at that now.
You love how nothing's been mentioned about it, right? Because they forgot to mention they bought all of the Nvidia chips and didn't count it in their operational expenditure. They said, we spent $4 million training this. They forgot about the $4 billion they'd spent creating...
No, that is another company.
Yeah, creating a cluster of thousands upon thousands upon thousands of chips from Nvidia.
That story is how ridiculous the market is, right? And there's people getting blown up on the back of that, right? So there's accounts that have got blown up. People gone on these big stocks where they've had in the long term is a small dip, but actually in the short term was probably quite deep. People have been rammed by that.
You just don't use leverage and then you'll be all right.
Yeah.
There you go.
Everyone's going to use leverage all the time. It's a very useful tool.
I use leverage. Do you know where I use leverage? To not keep money on a broker.
I was going to say when you're spanking dollar Turk all over the place.
Jesus. To keep it, trade bigger positions, but keep it below the FSCS limit.
Yeah.
That's the best way to use leverage. So you don't have any counterparty risk, or limit your counterparty risk anyway.
Yeah, but of course people do want to use leverage, and they will use leverage. But of course, when you're trading stocks, it's a completely different beast to using leverage when you're spanking the dollar about, or trying to make some money on, like using leverage to trade meme coins or something.
Yeah.
So there you have it. Should you sell everything? The answer actually is no. You shouldn't sell everything. But there are signs that the market could be about to turn. But there's always signs that the market could be about to turn. Like, subscribe, keep hold of the Mag 7 stocks, and let us know if you agree or disagree. This podcast is for educational purposes only and is not intended to be financial, product advice, or any investment recommendation. It has been prepared without taking your objectives, financial situation, and needs into account. Any references to past performance and forecasts are not reliable indicators of future results. For more information, visit axi.com.